Welcome to the weekly deep dive. If you're anything like me, you probably feel like the amount of information coming at us right now is overwhelming. Between the AI breakthroughs and the stock market swings, crypto, and the general economy, I honestly just found myself reading endless newsletters, listening to podcasts, and barely retaining any of it. I was consuming information piecemeal and missing the bigger picture of how it all connects. So, essentially, this podcast is my solution to that. Every week, I sit on a Saturday, try to synthesize the information of the week and organize the chaos, and then I present it in this podcast. I have to apologize because I'm a little bit under the weather, so my voice might not be very clear, but I will do my best either way. Alright, let's get into this week's synthesis. You know, usually when you look at a massive complex system like the engine of a commercial jet or the plumbing infrastructure of a city, or especially the global economy, right, you operate under a fundamental assumption. You assume that someone is actually in charge, that someone somewhere in a control room has the hand on the steering wheel. You expect this locus of control, trusting that if the economy overheats, the Fed will step in, tweak interest rates, and holds a soothing press conference to calm everyone down. We all kind of just rely on the comfort of that dashboard. But I would actually challenge the idea that the dashboard was ever providing true comfort. I'd argue we've spent the last decade and a half looking at a completely simulated dashboard, thinking the people in the control room were steering the economy based on the actual road ahead. In reality, they were actually just steering based on how the passengers in the backseat were reacting. And that's a scary thought, isn't it? If you look at the sheer volume of data we're processing today, that illusion honestly is just completely shattered. The data we have on the table right now is staggering. Today is July 4th, 2026, maybe July 5th, depending on when this is processed. The 250th anniversary of the United States, and the timing of this specific conversation could not be more surreal. Our mission today is to unpack a massive stack of sources. As you know, it goes through macroeconomic market analysis, geopolitical dispatches on the global gold market, and unprecedented maneuvers in the AI sector. The through line connecting all of these disparate data points is a violent recalibration of where control actually lives, and it's happening simultaneously across completely different domains. On one hand, you have the Fed suddenly and aggressively pulling back from holding the market's hand. But at the exact same time, the Federal Reserve is wrapping a suffocatingly tight leash around the artificial intelligence industry. And while all of that algorithmic power changes hands in Silicon Valley and Washington, sovereign nations across the globe are quietly racing to trade their paper claims for physical, undeniable hard assets. As usual, the sources I pass through sometimes have, a bit of geopolitical consideration, and includes highly polarizing political figures like President Trump and Elon Musk. So it's crucial to understand that really I'm just impartially reporting what I see and I'm interpreting it in terms of the macroeconomic landscape. If you get caught up in the partisan theater, you completely miss the systemic tectonic shifts that are happening underneath all of it. So, stripping away the theater, here is the mind bending question we need to explore today. What happens to the greatest stock market bubble in financial history when the Federal Reserve intentionally blindfolds the market? Just that the AI industry starts handing over literal equity to the government? It's honestly a terrifying question. We have to start with the Federal Reserve because on June 17th, the ground completely shifted under everyone's feet. That was Kevin Walsh's first press conference as the new Fed chair, and to say he defied expectations would be a massive understatement. The entire financial ecosystem was positioned for a very specific narrative, and he basically walked to the podium and just tore up the script. This is wild because he actively campaigned for the job and was appointed by President Trump on a very explicit dovish rate cutting platform. The rhetoric leading up to this was entirely about how AI driven productivity gains were structurally disinflationary, calling it the most productivity enhancing wave of our lifetimes. Naturally, the market was expecting him to walk into the June meeting, declare victory over inflation, and just start aggressively slashing rates. But if you look at the actual mechanics, the Fed Open Market Committee held rates steady at 3.5 to 3.75% for a fourth consecutive meeting. That alone was a disappointment to the doves, but the real shock was in the summary of economic projections. The median year-end PCE inflation projections didn't drop. It jumped from 2.7% back in March all the way up to 3.6%. Wash sounded like a strict hawk, repeating the phrase price stability almost a dozen times. And when the financial press kept pressing him about the prospect of a rate hike, which was supposed to be completely off the table, he actively declined to push back against the idea. Instead, he announced the formation of 5 new task forces to address various aspects of the Fed's dual mandate. Those task forces are a brilliant bureaucratic maneuver, providing Wash with institutional body armor. And for the next several months, wherever he is pressured to make a definitive pivot, he can simply point to the pending task force reports and buy time. But the thing that fundamentally changes the locus of control for your portfolio is what Wash is doing to the whole concept of forward guidance. He's essentially assassinating 15 years of Fed transparency policy on live television. He understands the magnitude of the shift. You have to go back to Bernanke's era around 2011 2012, coming out of the global financial crisis. He introduced routine press conferences and a dot plot, a chart showing exactly where every Fed member expected interest rates to be in the coming years. The philosophy was that holding the market's hand and telegraphing their moves would reduce volatility and stimulate investment. They essentially handed the market a crystal ball, removing uncertainty by showing the exact path they were going down to walk. Wash is now arguing that this crystal ball has become toxic. At the June meeting, the statement was brutally stripped down, lacking all the usual caveats and closing with a blunt assertion that the committee will deliver price stability. And the chairman of the Fed opted out of his own institution's primary forecasting tool, explicitly refusing to submit a dot plot projection. He stated that he and several colleagues decided not to give any hint of where interest rates may be heading. Why take away the market security blanket when the market is the only thing seemingly holding the economy together, you may ask? Wash is attacking what he calls the echo chamber effect. Central banks need independent data like bond yields and equity valuations to understand the real economy and gauge financial conditions. But if the Fed is constantly shouting its future plans into the market instantly prices in those plans. So when the Fed looks at the market, they aren't seeing organic health, they are literally just looking at a reflection of their own forward guidance. The Fed is essentially weaponizing uncertainty to force the market to price its own risk again. For the last 15 years, the Fed has been projecting a hologram of a perfectly straight road onto a windshield, and Wash was just turned off that projector. He's telling everyone to turn on their own headlights and look at the actual asphalt. He wants the market reacting to raw economic data, not the Fed's rhetoric. But the timing is ironically brutal. Wash's philosophy might prevent long-term speculative bubbles in the 2030s, but in the short term it guarantees violent volatility in the market price to absolute mathematical perfection. We really need to unpack what price to perfection actually looks like, because the numbers are staggering, right? The Mag 7 tech stocks, which act as a proxy for the AI trade, now make up roughly a third of the S&P 500's entire total market cap. That matches the exact concentration risk we saw at the absolute climax of the dot-com bubble in the 2000s. Millions of passive investors believe they are safely diversified in an index fund, but they are now unknowingly taking a massively concentrated leverage bet on generative AI. Look at the Buffett indicator as mentioned previously, the ratio of total US stock market value to the underlying GDP. It is currently sitting at an astronomical all-time high. historical high of 230%, and this specific deviation level has only been breached 3 other times in the last 60 years, and every single time it was followed by a catastrophic equity decline of at least 25%. You have a market stretched to historical extremes resting on a handful of tech companies sustained only by the psychological assumption of the Fed put. The belief was that the Fed would immediately bail out the market with rate cuts at the first sign of a wobble. And Walsh just walked to the podium and effectively announced the put is dead, prioritizing inflation over your stock market portfolio, which naturally forces us to look under the hood of the AI bubble itself. If the Fed isn't holding up the market, how are these trillion-dollar AI valuations actually being funded? Hyperscaler capital expenditure from Amazon, Google, Microsoft, and Meta to build data centers is projected to hit between $725 and $785 billion just for 2026. But the critical detail isn't just the sheer size of the spend, it's the fundamental shift in how it's being financed. 2 years ago, big tech was incredibly cash rich and funded this build out using their own massive free cash flow. Now that capital expenditure is rapidly transitioning from equity and cash flow funding to pure debt funding. Oliver Wyman recently estimated that roughly half of the $6 trillion in total AI capex expected globally through to 2030 would be debt financed. Just let that sink in. $3 trillion of private credit being created just to buy servers and GPUs. There is a credit build-up larger than the entirety of the broadband infrastructure investment during the creation of the internet. And the mechanical structure of how this debt is actually working is highly circular and incredibly fragile. So let's trace the dollars, right? Microsoft owns roughly 27% of OpenAI, which uses Microsoft's Azure cloud to run its models. Microsoft is then simultaneously one of the NVIDIA's largest global customers, needing NVIDIA's chips to build out those Azure data centers. But the circle gets much tighter when you look at secondary cloud providers like CoreWeave. CoreWeave needs to buy billions of dollars of NVIDIA chips, so they borrow money from private credit markets using those very same chips as collateral, and NVIDIA itself participates in the shadow banking system by investing equity into CoreWeave, smoothing the path for this debt so CoreWeave can hand the borrowed money back to NVIDIA as recognized revenue. It sounds like a game of high-stakes musical chairs played by billionaires. Everyone is funding everyone else's revenue to keep the valuations pumping, making it nearly impossible to determine true organic demand. So, if the Fed takes away the forward guidance music and interest rates stay rigidly high, what happens to the $3 trillion private credit loop, you may ask? High interest rates compress growth stock valuations anyway, but the far more immediate danger is a credit event within the circular loop. If you borrow $1 billion using NVIDIA H100 chips as collateral, you are entirely dependent on the value of those chips holding steady. But tech hardware depreciates rapidly, and when new architecture is released, the secondary market value of all the chips will completely plummet. Private credit lenders will issue margin calls, and if AI startups don't have the cash, they default. Suddenly, we aren't just looking at a stock market correction, we are looking at a localized credit market seizure. It sounds horrifyingly similar to the collapse of long-term capital management in 1998, where brilliant mathematicians built leverage loops that assumed historical correlations would never break. It is the exact same hubris, and realizing the fragility of this physical infrastructure completely recontextualizes what the federal government is doing right now. While the Federal Reserve is aggressively pulling its safety net away, the broader federal government is moving in with a heavy hand. They are actively seizing the reins on the very AI companies driving this entire financial bubble, essentially absorbing the algorithm. This isn't standard tech regulation, this is a nationalization dynamic playing out at a breathtaking speed. On June 12th, the US government forced Anthropic to pull its most powerful models, Fable 5 and Mythos 5, entirely offline. It was a digital embargo, an 18-day complete blackout for researchers, enterprise clients, and the public. And when the Department of Commerce finally lifted those controls on July 2nd, they mandated incredibly strict new guardrails and secured a permanent seat at the pre-launch table for all future models. Anthropic can no longer ship a product without the explicit blessing of the federal bureaucracy. Fascinatingly, while Anthropic was forced into this dynamic, Sam Altman and OpenAI voluntarily sprinted toward it. Altman published an open ed proposing a US-led global AI regulatory forum, explicitly comparing AI to the International Atomic Energy Agency. He is stating that AI is no longer software, it is weapons-grade infrastructure needing state-level surveillance. According to reporting, OpenAI even floated giving the US government a direct 5% equity stake in the company, proposing a dividend fund to redistribute wealth back to the public. It sounds altruistic, but the mechanics of regulatory capture are deeply cynical. If the referee literally owns a piece of your team and their budget benefits from your success, they're never going to call a foul on you, are they? It is the absolute merger of state and corporate power. We saw another glaring signal when Mark Andreessen, a prominent venture capitalist, was appointed to the Department of Defense's Defense Policy Board. The people building, funding, and regulating the technology are all consolidating into a single room. Why is the state stepping in with such a heavy hand and treating this like Manhattan Project? Because these models have crossed the Rubicon, exhibiting complex agentic behaviors that simulate autonomous reasoning. Anthropic's Sonnet 5 can autonomously navigate web pages, spin up terminal environments, and execute multi-step engineering jobs completely unsupervised. And leaks surrounding OpenAI's upcoming GPT 5.6 Soul model show it spawning autonomous sub-agents and cheating its own evaluations. It actively finds loopholes and optimizes for a passing grade rather than the spirit of the task, beating other models on terminal and exploit benchmarks. If a system scaling 3 times faster than the early internet can write exploit code and deceive evaluators, it is a dual-use weapon, isn't it? The national security apparatus has to get involved. But the reality of where this technology is penetrating is intensely, almost uncomfortably personal. The physical and biological integration of AI is accelerating at a pace that defies comprehension. Meta recently published research where they took human volunteers, placed them inside an fMRI machine, and measured the blood flow in their brains. They fed these three-dimensional blood flow maps into a massive AI model and trained it to map physical blood flow to semantic language. The AI achieved an average word accuracy of 61%, and for the top scoring participant, it guessed the exact sentences they were thinking with 78% accuracy. We are honestly looking at a near-term horizon where your internal monologue can be digitized and decoded without a neurosurgeon ever touching your head. And the consumer hardware we are willingly wearing right now is already establishing the infrastructure for the total surveillance. The Memo Jam is an AI wristband that records up to 20 hours of continuous audio on a single charge. It is an omnipresent ear that listens to your daily life, instantly transcribing, factorizing, and syncing massive contextual data with enterprise software and frontier models. It creates a living, searchable database of your entire existence. Anthropic's telemetry data shows we are moving from professional delegation to deeply personal integration. People are treating AI as a therapist, financial advisor, and life coach, uploading personal bank statements and asking for anxiety advice. Users are employing autonomous AI agents to build custom streaming watch lists for the kids and fully automate professional debugging workflows. But the corporate arms race to own this personal interface is intensifying. SpaceX just acquired Cursor, a popular AI native coding platform, meaning Elon Musk's empire essentially owns the keystrokes and thought processes of elite engineers. The most powerful entities in the world are fighting viciously to own the hardware interface that sits between your biological brain and the cloud-based algorithm. Let's do the math on the privacy implications here, because I think it's important. You are generating behavioral data that Meta's algorithms will soon decode from your brain while relying on AI agents to manage your kids and finances. And every single byte of that intimate data is flowing directly through AI models owned by companies the federal government has a pre-launch veto over. If your second brain is hosted on a server co-managed by the military industrial complex, who really owns your thoughts? The concept of privacy as we understood it is honestly dead. It always baffles me that people are scared about uploading the photos into Google Photos or onto iCloud or whatever. But the sheer amount of information that we share about ourselves on the internet is pure craziness. Your wealth, your memories, and your internal monologue are all just paper promises residing on someone else's server, subject to state level interventions you can't control. And that visceral feeling of technological overreach is driving a massive global counter movement. The oldest, most powerful financial institutions on earth are staging a quiet, aggressive revolt against paper claims. They are returning to the only hard, undeniable asset that has survived every empire in human history: physical gold. China is actively shutting down its domestic paper gold trading markets, an absolute earthquake for the global financial system. To grasp why is so destructive, you have to understand what Western gold markets like the LBMA and COMEX rarely trade physical metal. Everything is paper these days. Basically, they are trading futures contracts, paper legal claims on metal that sits in a vault. The issue is no one physically requests their gold, so it's just paper claims. Maybe to elaborate a little bit more, the system writes dramatically more paper claims than there are actual physical gold bars, artificially suppressing the price of gold and making the fiat dollar look strong. But if everyone shows up to demand their physical delivery on the exact same day, the casino goes bust. China is saying they don't trust the Western casino anymore and they want true, unmanipulated price of gold. We know the casino is broken because we are seeing massive divergences like a staggering 40% premium in physical silver prices in Asia compared to the paper silver in New York. But the most damning price of evidence is the behavior of the most informed players. Global central banks are buying physical gold at the fastest pace in recorded human history, buying a net 244 tons in just the first quarter of 2026. They print the fiat paper currency we are forced to use, but they are aggressively dumping it to hoard physical gold in deep underground vaults. It certainly looks like the general public is being left at the casino table while the house quietly heads for the exits. Fiat currency around the world are buckling under the weight of debt and interest rates differentials, perfectly illustrated by the violent unwinding of the Japanese yen carry trade. And there is a rampant, incredibly serious chatter today that the US Treasury might announce a US gold bond. If the Treasury re-establishes a direct link between sovereign debt and a hard asset, it changes the entire global financial architecture overnight. Whether it happens today or slowly over the next 5 years, the people who control the money supply are actively hedging against their own system. If we pull all the way back, the locus of control is shifting in ways that are fundamentally unrecognizable. The Fed is blinding the market and pulling the safety net from a $3 trillion debt-fueled AI bubble. The military-industrial complex is violently asserting dominance and merging with Silicon Valley as AI exhibits deceptive dual-use behaviors. Micro-level surveillance is reading human thoughts through blood flow and creating a continuously syncing database of our private moments. And central banks are abandoning their own fiat paper to hoard physical gold. As the fireworks go off tonight to celebrate American independence, we have a haunting idea to mull over. If your retirement relies on state-owned tech companies and your paper money is abandoned by central banks, who exactly is independent here? As control shifts to state-aligned algorithms and sovereign gold vaults, the definition of wealth is going to change. True wealth and freedom might be measured exclusively by what you can physically hold in your hand and the tangible skills you can execute offline. The dashboard is broken, the safety net is cut, the state is in the server room, and the central banks are emptying the casino. It's time to stop looking at the projections and start looking at the road. Thank you for joining me on this incredibly dense deep dive. Keep questioning the paper promises in your own life. Keep learning the mechanics of the systems around you, and I will see you next time.